So what's happened over the last year is that we've seen liquidity evaporate the interbank market. That's yet to fully return. We've seen origination volumes plummeting in the banking industry in North America and to a certain extent in Europe. So, for example, subprime mortgage origination is down 95% over the last year. That's probably a good thing, a little bit too late. Leverage loan origination down more than 70%. Credit spreads have widened and so forth. So the question on everybody's mind is, will there be a recession in the US? What will happen in Europe? How long will all of this last? And what will be the impacts? So what we want to do is just take a few minutes and share with you some of the analysis that we've done in McKinsey, actually in our North American part of the firm, to try to estimate what the likely magnitude will be of the overall losses coming from this credit and liquidity crisis. Then talk a little bit about the outcomes and implications for financial institutions, which are quite systemic and important for the overall economy, and then talk a little bit about the lessons learned coming out of all this. What have been the response globally from the regulators and the industry? How can we have any confidence, if we're going to put our capital to work, that we're not going to look at a repeat of this later on? So let's begin by talking about the losses themselves. What we did at McKinsey was we took the 49 trillion of debt owed by US borrowers. That's 49,000 billion, of which 28% is consumer debt, 34% commercial or corporate, and 21% government debt. That includes the debt from Fannie Mae and Freddie Mac and so forth. And we, under a series of different economic scenarios, we attempted to estimate the losses that would result from all of these obligations of US borrowers. So I'm talking now about actual credit losses arising from default. Okay? And the three economic scenarios that we looked at, we did this analysis back in about May. The first one was a steady recovery, slowdown short and mild, relatively quick recovery underway by now. Sadly, as we are here in September, this scenario is no longer even a possible scenario. Then we looked at a sort of middle severity scenario where the US and UK experienced slow growth, i.e. little or no US growth in 2008, or mild recessions lasting at most 2 to 3 quarters. Europe and Asia slow but avoid full recession. The securitization markets recover next year, but largely just with the plain vanilla kinds of securities. Banks raise further capital, and some minor banks require rescuing and bailout. Then we looked at a more severe economic scenario. So we called the middle scenario the long chill, and we looked at a more severe scenario, that we call the prolonged contraction scenario. This is where the US and UK experience prolonged recessions, and Europe and Asia also become coupled, given the slowdown in world trade. The credit markets remain depressed throughout the rest of this year and all of next year. Securitization markets don't recover, and banks are unable to expand their lending to fill the gap. So the shortage of credit availability exacerbates the slowdown in the economy. And there's large-scale capital raisings by banks and further government intervention. So looking at those scenarios, what did we see as the total losses, actual losses coming from these obligations of US borrowers? So here's the chart, and this puts the three McKinsey estimates in a range. So various folks have estimated the total losses from US obligations up to $2 trillion. That's the Allianz Dresner estimate. So the McKinsey estimates for the most mild top scenario is the dark blue bar. That number is 625 billion. For the middle long chill mild recession scenario, that's 800 billion. That's the left hand of the green bars on the left-hand chart. And for the more severe prolonged contraction scenario, that's 1.28 trillion, 1,280 billion. To put these estimates in context, as a percentage of US GDP, the mild recession scenario, which is the middle of the three, is about almost 6% of GDP, and that's about 50% more severe than the losses from the S&L crisis. The prolonged contraction scenario is about 9.6% of GDP. Okay, so in the middle scenario, the totaling $800 billion, how do these losses break out? What we see is that about 2/3 of the losses are likely to come from residential and commercial mortgages. So you've got $280 billion there from subprime residential, another $140 billion of actual experienced losses from residential mortgages that are not in the subprime category. That's a big number. About $120 billion of commercial mortgage losses, $130 billion on consumer credit, including things like auto loans with residual values of sports utility vehicles plummeting with $4 a gallon petrol. And then $130 billion on corporate credit. That includes things like leverage loans. Now, importantly, away from the residential mortgage area, most of these losses haven't come through yet or been fully provisioned. So there's still a fair bit in terms of actual default and write-offs and provisioning still to come. What we have seen is markdowns in securities, these highly structured, collateralized debt obligations, CDOs, so-called, and things like this. But in many cases, the actual defaulted loans and losses have not yet come through. So US housing has really been at the epicenter of the crisis. Let's focus on this for a minute or two. I think for a long time nobody understood the interdependencies on the various components of the system on the home borrower. Thought we were just buying a house. Didn't realize the entire global financial system depended on our mortgage. So you've already seen the chart about Case-Shiller. Won't belabor that at all. That's the index that's most closely tracked, 20 cities, house prices in 20 cities in the US. As of last week or 2 weeks ago, when the most recent values of the index came out, all 20 of the cities were down. The most severely hit were Miami, Las Vegas, and Phoenix, which were all down between 28 and 30%. So a bit of variation around the country, but down everywhere. So the question is, how much further to go? I don't know, but when we have these discussions with the CEOs of the largest financial institutions in North America and Europe, most of them are expecting peak to trough in US house prices of anywhere between 25 and 35% down. The more optimistic folks say 25, the more pessimistic say 35. Goldman Sachs, for example, has a stress test of down 40% peak to trough. In any event, very severe. So just to put this house price bubble in context, those of you who remember the late 70s housing bubble and the late 80s housing bubble, this bubble is quite unprecedented, fueled by the low interest rates and easy credit that we heard about earlier this morning. So this is just a graph of the house price index, and you can see how far it's deviated from the trend line in the recent bubble. So there's a very interesting paper published earlier this year entitled, "Is the 2007 US subprime financial crisis so different? An International Historical Comparison," by Ken Rogoff, and another co-author. What they did was they looked at a whole raft of international banking crises and tried to compare those with the current subprime crisis. I've listed 5 here on the chart. Those are Spain in 1977, Norway in 1987, Finland in 1991, Sweden in 1991, interesting part of the world, and Japan, of course, in the early 90s in 92. And their analysis of these crises suggests that typically those big 5 anyway had an average peak to trough house price decline of approximately 20% over and the declines lasted for 4 years on average. So on average, 20% peak to trough decline took 4 years to work through. So the US house price declines began in the middle of 2006, about 2 years ago, and are 18-20% off their peaks now. So that might suggest it might be reasonable to expect continued price declines for another couple of years. All right, let's look briefly at the impact of all this on wholesale banking, just for a couple of minutes. What we did at McKinsey was we forecast what will happen to global wholesale banking and investment banking revenues out to 2010 under each of these scenarios. And we've been sharing these forecasts and this analysis with the largest global wholesale banks and investment banks in the Northern Hemisphere. Just before we show you the results of that, the credit and liquidity crisis, the subprime crisis, if you will, has hit these wholesale banking revenue pools most significantly in the primary and secondary credit businesses, so debt capital markets and the secondary credit businesses. And what you see here on this chart is the revenue pools in Europe and the US in 2006. So 123 billion in Europe, 120 billion in the US in 2006. And what you can see is that those segments that have been hit worst, in Europe they account for 24 billion 2006 revenues out of 123. It's roughly 20%. And in the US they account for 42 billion out of 120. That's roughly 35%. So the point here is that in a proportional sense, the US wholesale banking industry has been hit about twice as hard as Europe under these scenarios. So let's see what happens. Under the long chill scenario, what we see is that this is revenues from 2005 through 2010 forecasted out. We see the revenues in 2006 globally were 315 billion. Under this middle mild recession long chill scenario, it takes 4 years for wholesale banking revenues to recover to their 2006 levels, and obviously worse in the more extreme prolonged contraction scenario. So what's interesting here for us, I think, the second tier of dark blue on these charts is the non-Japan Asia revenues, which were 22 billion in 2005, 32 billion in 2006, and under this scenario are forecast to be 48 billion in 2010. So what we actually see is a fairly profound shift in the geographic mix of revenues under every scenario. So under all scenarios we see a profound shift in these wholesale banking revenues towards the emerging markets. So non-Japan Asia was 10% of global revenues in 2005. Under the long chill scenario, it's 15%, steady recovery 18%, and approximately the same under the prolonged contraction scenario. And Latin America, Eastern Europe, the Middle East and Gulf region increasing from 5% to 10%. So in total then, these emerging market revenues in 2005 accounted for about 15% of revenues, and in 2010 about 25% of total revenues. Okay, let's look at, just for a moment, the potential outcomes and implications for financial institutions, many of which are struggling today. We've forecast these losses coming out of these obligations of US borrowers. We've done a similar analysis for obligations of European borrowers. And then what we've done is we've attempted to estimate what fraction of those losses will actually be sustained by the banks and investment banks. Because there has been a fair bit of credit risk transfer into the hands of many other investor categories. So just for the purpose of this analysis for the moment, let me take you through the top chart. So this is the numbers under the two more severe scenarios. So the middle scenario, the mild recession scenario, the long chill, we said that there was about 800 billion worth of losses to be experienced. We think about 53% of those losses will actually be experienced by banks and investment banks. That gives you about 420 billion, which is the first number on the top bar chart there. The analysis of European losses, or losses from obligations of European borrowers, comes to a total of about 205 billion. We think that about 63% of those losses will be sustained by banks. That gives you the 130 number, which is the second number. For total credit losses globally from those obligations, US and Europe, of $550 billion. As of a couple of weeks ago, the total write-downs to date are about $500 billion. Now that again includes mark-to-market write-downs. So in aggregate, you could expect another $60 billion. If you think we're in that middle scenario, the milder scenario, then we're 90% done in terms of total write-downs in the banking system. Conversely, on the bottom, more severe prolonged contraction scenario, 53% of 1.28 billion is 680 billion, taking you to a total of 810. We've seen about 500. That means we've still got, if you think we're in the more severe scenario, probably still about a total of 300 billion to go. Now, what you're going to see probably is some writing back of the values of some of these securities positions, which to many observers look cheap. For mark-to-market accounting purposes, they've had to be marked down very aggressively. But if you look at what the implied underlying default rates are on those securities, we just don't, at McKinsey, we don't see those default rates actually materializing. So we think there's a strong possibility that some of those securities will ultimately eventually be revalued up, but then the actual credit losses will come through when the defaults, over the next year or two as the defaults happen. And what we're saying here is that there is net 60 or 300 billion worth of further losses to come. So what about capital? Although we've seen 60 to 90% of projected losses from these exposures already taken, the really interesting thing here is that banks and securities firms have raised only about 45 to 60% of the capital that they need to rebuild their balance sheets. This analysis is as of about middle of August, 11th of August. So starting with on the left-hand side, the total projected losses, which were 550 or 810 from the previous slide. We have to add to that, have to recognise the fact that some off-balance sheet assets are coming back onto bank balance sheets, and that requires an extra 80 billion in capital to support those. We've calculated about 130, 135 billion worth of capital required to support future loan origination, given the drying up or seizing up of the securitisation markets. There's a tax shield in there, and all of this leads to a total capital shortfall of about 600 billion in the middle scenario and 785 billion in the prolonged contraction scenario. To date, banks and investment banks have raised about 350 billion of that total. So under the middle scenario, that leaves about 250 billion still to be raised. And under the more extreme scenario, that leaves about 430 billion still to be raised. So where's that capital going to come from? A lot of the folks, the sovereign wealth funds and others who, kicked in some capital in the first round late last year, are not delighted with the return on their investment to date. It's not completely clear where all of this capital is going to come from. So to rebuild their balance sheets, banks and securities firms need to raise an extra 250 to 430 billion in capital. They have to rely on gradual capital formation via returned earnings over the next 2 to 3 years, or deleverage by selling assets and further withdrawing credit availability. So, for financial institutions, the name of the game for the next 18, 24 months, it's all about capital and liquidity. So what are financial institutions doing to respond to the credit and liquidity environment? Essentially rebuilding their capital base, we've just discussed that, reducing their costs. So I would say McKinsey globally, in North America and Europe, we're doing more cost reduction work today than we have at any time in the last 10 years. That's a major fraction of the work we're doing with our Northern Hemisphere clients right now. Strengthening risk management. This is a pretty critical element. No matter how you look at this crisis, among many other things, this has been quite a catastrophic failure of risk management, and there's urgent work going on in the industry and in the largest institutions and on the regulatory side to try to make more robust the risk management infrastructure and processes in these institutions. Finally, for the relatively small minority of institutions that have dodged a bullet and find themselves in a very strong position, they're re-examining their business segments that depend on the originate to distribute business model, but they're also selectively pursuing strategic opportunities that this situation offers. If you will, they're taking advantage of the fact that everybody else is distracted, and in particular, the US is on sale. So what are the lessons learned? Okay, here's a slide that you're deliberately not meant to read. The point of this slide, from a great distance, is that if you attempt to write down all of the factors that contribute to this crisis, you can pretty quickly write down more than 30 of them. And in general, they come under three categories. The first one is weaknesses in supervision, regulation, and accounting standards. So I think this crisis has highlighted massive weaknesses in bank supervision, especially in the United States. The second one is ineffective risk management practices. I just spoke about that. And I think the third and potentially most important of these major drivers is wrong incentives and behaviour. So the incentives contained or embedded within compensation practices in the wholesale and investment banking industries have been seen or believed to be a major driver of this crisis, driving inappropriate behaviour. What I've done is I've highlighted a number of these points, just to highlight 3 or 4 of them for you. Business not aligned, bottom left, business not aligned with the risk appetite and risk competence of the organisation. So in a number of institutions, they piled these highly funky, complicated CDOs on the balance sheet, more than 50 billion, and no one ever approved for that to happen. That wasn't even part of the approved business model, and the risks were definitely not understood. Down in the middle towards the bottom, excessive reliance on credit rating agencies and insufficient own due diligence. After all, they're AAA, right? AAA is AAA. No, it isn't, as we now understand. As an investor, one has an imperative to do one's own due diligence and understand the risks of the assets that one is taking on board. On the right-hand side, a lack of integrated view of risks. This is critical. Risks were seen in bits and pieces, but the dots were never joined in most of these institutions. Back again at the bottom left, the lack of courage to act against market expectations. So in some instances, institutions saw there was a problem, had a discussion, should we cut our positions? And the answer was, we can't afford to miss the analyst targets for the quarter. So yeah, maybe we should, but let's the famous quote, right, from Chuck Prince, as long as the music keeps playing, we'll keep dancing. All of which was underpinned, bottom left, by compensation schemes with short-term incentives. So what are the lessons learned? Interestingly, there was a landmark report issued by global regulators called the Senior Supervisors Group. What this was the supervisors of the 11 biggest financial institutions sat in a room together and compared notes and issued a report in March. And this is the SEC, the Federal Reserve, the UK FSA, the Germans, the Swiss, the French, and so on. And what they did was they compared the characteristics and the actions taken in the institutions that did better and dodged most of the losses, and the institutions that did worse. So on the left-hand side of this chart, an attempt to summarise this report: characteristics of firms that did not do well, organisational silos, aggressive expansion of risk without clear guidance, inflexible risk systems, lack of an integrated view of risk. On the right-hand side, what are the characteristics of the firms that did better? The Goldman Sachs, the JP Morgans, the Wells Fargos, and so on. Top right, rich dialogue among senior management, business lines and control functions, robust dialogue as things were changing rapidly about risk and return, quick escalation processes from different businesses of information, and the risk appetite and control, that trade-off between risk and return, well balanced. Those first three bullets are really the characteristics of what these days is described as a strong risk culture. And you can see the other characteristics there as well. So what were the keys to success? First of all, the integration of risk and the understanding of risk across all the different businesses, not just the residential mortgage business, the securitization business, the investment business, the trading business, all businesses, joining the dots, if you will, and all risks, credit risk, market risk, liquidity risk, and so on, reputational risk. The second key, a strong risk culture, rich dialogue about risk and return in a rapidly changing situation. And thirdly, the courage to act. Many institutions saw the risk escalating rapidly. Very few were able to act in time to reduce their exposure before it was too late. So, formally, what we've seen is a very robust global response. We've seen the global regulators getting together and coming up with a unified regulatory response through something called the Financial Stability Forum, which is financial authorities from 12 countries, including Australia. The RBA was involved. The International Monetary Fund, the European Central Bank and others were also part of the Financial Stability Forum. They released a 100-page report of their actions in early April. That report was unanimously endorsed by the G7 finance ministers at their April meeting. And I'll highlight a couple of elements of the regulatory response in a moment. Secondly, and in parallel, we saw an industry committee that Greg alluded to in the introduction at something called the Institute of International Finance. This is the global banking industry association headquartered in Washington. It created a committee on market best practices late last year. And it included, for example, all of the major rating agencies. Only the Fitch logo is highlighted here, but Standard & Poor's and Moody's were also on that committee, represented by their president or CEO in each case. The major banks, interestingly enough, not much representation from our time zone here. And this committee worked for about 9 months to lay down some principles of conduct and best practice recommendations in 6 different areas, which attempted to incorporate the lessons learned from the current crisis. So let's talk quickly about some of the regulatory changes. First of all, you're going to see higher capital requirements for certain activities that banks and investment banks engage in. The first one is securitization. The second is trading activities. So everything to do with trading, market risk, counterparty credit exposures for traded positions, and backup liquidity facilities. You'll see adjustments to Basel II, which is the global standard for how much capital banks need to hold for their various activities, and the proposed adjustments have already been issued by the Basel Committee for comment. Introduction of strict liquidity measurement and management, again, as a very substantial addition of Basel II, including increased liquidity buffers. So the Basel Committee issued its liquidity, big liquidity paper with all of its new requirements on liquidity in late June for comment. The regulators are demanding a strengthening of risk management in banks. This is going to take time and be expensive. In particular, what's happened in a number of countries, like Canada, for example, is that the regulator has called all the banks into the room and said, we want to see your self-assessment versus these committee best practice recommendations. Where do you stand? Those recommendations are in the area of credit underwriting, liquidity risk management, compensation policies and practices, incentives, if you will, valuation practices, and transparency and disclosure. So in many countries, the regulators are asking now formally the banks to self-assess themselves. And they're sending the message that if banks don't step up to close the gap versus these best practices, some of these requirements may become regulation. And there's a raft of other options that regulators have in their back pocket if the crisis should worsen even further from here. So, final slide. We believe that taken together, the global regulatory and industry responses, which we'll see implemented over the next couple of years, do remedy many of the identified shortcomings. In particular, just to highlight a couple, top right, raising the capital requirements for securitization. We talked about that. Now, there's a timing issue there. This is exactly the moment when banks are short of capital. Is this the moment to require them to hold more capital for these activities? In discussions with the Federal Reserve and others, they're acutely aware that maybe some delay is probably wise at this time before introducing these higher capital requirements. So there'll be, I expect these will be phased in over the next couple of years. The big one is around liquidity management in the middle on the right. Common international standards for liquidity risk measurement management in banks. We've never had that. Never had that. It's been a best efforts basis up until now. Consistent approach for supervisors to supervise liquidity in the different banking systems globally. And all of this, based on the guidance that's been issued just a month or so ago from the Basel Committee, will mean higher liquidity buffers. On the left, in the middle, we expect the rating agencies have been hammered. Their reputations have been really smashed as a result of aspects of this crisis. And one of the recommendations coming out of this Committee on Market Best Practices is that we actually have a different scale of ratings, a separate labelling, if you will, for ratings on structured products so that nobody has the opportunity to just think AAA is AAA, because AAA on a structured security is not the same thing as AAA on a corporate bond, which we all sort of have known and understood for a long time. Finally, the hard part. The bottom left-hand corner here, supervisors to work with market participants to review incentive compensation structures. So the Financial Stability Forum has set up a committee to look into and review incentives and compensation structures in the wholesale and investment banking industries. They've asked the Institute of International Finance to begin with a global survey on those practices. Frankly, this is an area that's very difficult, but, well, this is seen as a collective action problem, right? There's no first mover advantage for any bank or investment bank in changing their compensation policies if none of their competitors are doing the same. So, in short summary, lots of action taking place on the industry side and the global bank regulatory side to digest and understand and move quickly to implement lessons learned, to try to provide assurance from a global systemic perspective that nothing like this can happen again. Unless that confidence is forthcoming, it's going to be extremely difficult to convince the folks who do have the capital to, put their equity and capital back into the banking system. And as you can see, that's highly needed at the current time. So with that...